everyone. I'm John Wilson with Ninepoint Partners, and I'm here to speak to you about the enhanced strategy, giving an update, quick review of last year and where we're going forward in 2019. So I guess just by way of starting, 2018 was a very difficult year for the strategy. We did do a deep dive on the challenges the strategy faced in 2018 back in December, and I would point you there if you want to get more detail. We went into great detail on specific equities that underperformed, as well as the performance of our hedge book in that webcast. I guess by way of a bridge from that webcast to this one, we're now at the end of the first month of 2019, the best month for the S&P, I think, in 32 years. So clearly a bounce back. We did see that in our portfolio as well, which had its strongest month since the inception of the strategy 7 years ago. So we're obviously pleased with that, although we clearly intend to keep trying to drive positive returns month over month here. One of the more interesting elements of the snapback was just the dynamic of what has worked so far in 2019, and it maybe not that surprisingly is the largely the items that were heavily hit as we went through November and December. As we talked about back in December, we really didn't understand the context for the sell-off. Clearly there were worries over a global recession forming, slowdown in China. People started to translate that into the Fed having raised rates too far, and therefore we were going to have a recession in North America and the developed world as well. We didn't see any of that. We don't think the fundamental data points to any of that. We didn't understand why the cheapest parts of the market were the ones selling off the hardest. As a value investor, those are the ones we tend to own. And fortunately, those areas have bounced back the best in 2019 so far, and we'll get into some more detail on that in a moment. But what I did want to start with was where we can go from here. And as I just mentioned, our starting assumption coming into 2019 is the same as the one we had through the fourth quarter of 18, which is that we're not entering a recession, nor are we about to enter one. In fact, I'd point to the jobs data again this morning, which, just like December's job data, was incredibly strong, over 300,000 jobs created. And yet the unemployment rate ticking marginally higher because more and more people are being drawn back into the workforce. Wages are climbing. It's just a really robust job market, which indicates, of course, a healthy economy. That said, the hard data has actually been fairly consistent the whole way through. What has been pointed to by people who are in the camp that we are threatening to enter a recession has been more sentiment-oriented data. So people's consumer confidence, business confidence, some of the PMI data. And a big element that has depressed sentiment has, of course, been worries over trade. That has been the wild card since President Trump was elected. Of course, a key plank of his platform was sanctions on trading partners. He has a bizarre view that every trading relationship is bilateral and should be either balanced or in the U.S.'s favor. And of course, he's gone on to impose sanctions on various countries, including Canada, and more recently impose substantial sanctions on the Chinese. We would point out that his pattern, long before he became president, is that Donald Trump was always more interested in promotion rather than substance. And in fact, if you look at how, as an example, the NAFTA fracas was settled, there were really only minor, very minor changes to the underlying existing agreement. But he changed the name and trumpeted it as a whole new agreement and a big win for him and his administration. So we like to think of it as he likes to be able to claim that he won more than he likes to actually win. And we think that may be the case with China as well. We're already seeing some preliminary signs of that. An announcement last night as the recent Chinese trade delegation left Both sides called it substantial progress. The Chinese saying they're willing to buy more U.S. goods, which they've been saying all along. But of course, no other details of anything meaningful actually changing between the two countries. And we think, frankly, there's unlikely to be substantial change in the trade relationship. That said, there is almost no doubt that at some point here in the relatively near future, the Trump administration will trumpet substantial wins against China as something to lay claim to. And I think a big reason for their incentive to do that has been how badly they handled the shutdown. That was clearly a loss, both politically and perception-wise for Donald Trump. And he desperately needs a win to win back Republicans in Congress and his base. Because of that, we think the odds of a shutdown, what we call shutdown 2.0, in other words, another shutdown once this temporary funding bill expires in mid-February, we think the odds of that are virtually zero. There's frankly no appetite in Congress among Republicans to go through that shutdown again. They saw that as a PR disaster. The first one, they all lost substantial points in the polls. So despite all of Trump's threat, we think there's almost no likelihood of another shutdown. And finally, the third element that's hanging out there is Brexit. Of course, that's been out there for 2 years. And as we said at the time when Brexit first happened, it would go right to the finish line and be badly managed the entire way. And that certainly the British Parliament has lived up to their side of the bargain. Frankly, unable to agree on anything other than they don't know what to do next. And so the most likely outcome with Brexit is that the deadline gets extended and the soap opera continues. As everyone has probably noticed, the market has not cared one iota what's happening with Brexit, and the farther we get into this, the more people seem to realize that it would have really a limited effect on most North American businesses. So with all that, the market multiple has re-rated higher. We troughed coming through the end of last year at under 14 times forward earnings, about 13 and a half times the 2019 estimate, which did come down a bit. It's sitting around $172 for S&P earnings now. That's down from closer to 180 midway through last year. And yet we bounced about 2 multiple points. So we're sitting around 15 and a half times that lowered number. That translates to about 5% earnings growth, which we've always felt was a reasonable estimate. One of the things we are all going to have to live with here over the near to medium term is that as much as what has been happening on those 3 areas of trade, the shutdown and Brexit, have been on balance relatively positive, there's still a lot of uncertainty around all 3 of them. That is likely to keep downward pressure on future growth forecasts, which does limit the potential for a lot of further upside on the market multiple. So I'm not saying the market multiple can't move higher from 15 and a half times. That's still below the historical average. If earnings growth and the economy stay healthy, and we think they will, there's probably room to add maybe another point to the multiple. But you're not going to see this market, in our view, trade up to 18 or 19 times the way we did earlier in the cycle. So all of that said, after a spectacular January, we do see risk-reward as more evenly balanced overall. That does not mean that there aren't parts of the market that are still remarkably cheap. We definitely think that's true. But from a hedging and a risk standpoint, we think you need to be a little more careful here than you needed to be as we went through the depths of late December and early January. So why no recession? This is slide 2. First of all, the Fed is on pause. Most people, including us, think at least until June. Real rates are actually sitting around 0, so adjusted for inflation, you're not really paying anything for money. As I mentioned, job growth is robust and unemployment is low, but the participation rate is still climbing, meaning that the market is starting to discount that there's a lot of slack still that can be taken up in the economy. And we're getting a Goldilocks scenario where wages are rising, but inflation is still contained. So the fact inflation is contained keeps the Fed on pause while wages rise and give people more buying power. The shutdown, thankfully, is over, and I think most people's view at the moment is that the economy seemed to have suffered very little damage from that. China is slowing and has been slowing for 2 years, but they have been adding more stimulus, and we think there's much more stimulus on the way. There's talk of fiscal stimulus as well as looser monetary conditions to help lending. And finally, the stock market has rallied, and as we saw with the Fed going on pause, they are very sensitive to the market because of its impact on confidence. And we do think as we roll into February, you'll see some of those sentiment indicators start to pick up as people feel a little better about the world given what the stock market has done. So we're going to step through the 3 key elements of our portfolio: our diversified equity book, the option strategies we're using to improve risk reward, and our general market hedging. So on slide 4, we'll take a look at where we added exposure during the sell-off. We did believe the sell-off was without merit, and we did see opportunity to add exposure during that period, and we did primarily focus on tech exposure. It got hit particularly hard, and there were some interesting areas to add. We added both the triple Qs and the software ETF, and then we collared both of those positions with we sold an out of the money call up about 10% and then bought protection underneath. And it allowed us to participate on a bounce back in the broad tech indices, but still have protection if the market went lower. So the way that's worked out is those both rallied, which has been great. And we still own the 2 of them, and we still have the protection underneath. We also added some individual names, in particular Alibaba and Adobe. We did play the bounce in Adobe and sold that earlier this month, but have kept Baba as a longer-term position, a company that's growing in the order of 40% that we still feel is very reasonably valued. Our overall book, from a sector standpoint, maybe not surprisingly, the areas that we felt were way undervalued and were undeservedly hit hard during the sell-off, financials and energy, remain our biggest positions. We did not sell down those positions during the sell-off. In fact, we added a little bit to the financials. We've added, you can see a new name there, Bank of Nova Scotia. On the energy side, it's the same book that we had coming through the sell-off. Tech, we've had quite a bit of switchover there. We moved on from, we sold Microsoft before earnings, as our work had said that the business was not going to be able to meet expectations. And as I mentioned, we did add Alibaba, the software ETF, IGV, and the triple Qs. We still own CGI. It's been a long-term holding of ours. A great free cash flow story that has been an excellent compounder for the portfolio. In healthcare, we continue to hold United Health, which again had another strong year in 2018. And we've added Anthem. We did that in the fourth quarter of last year and continued to build the position in 2019. On the utility and REIT side, we have both of the Brookfield entities, Brookfield Infrastructure and Brookfield Properties. On the industrial side, we've added a new name in Honeywell, as well as the existing names we had, CSX and CP on the rails, and a recent option position to play upside on Air Canada. And then the remainder of the book is quite small. Winners and losers year to date. We had done this slide, if you go back and look at the webcast in December, looking at what had hurt us in 18 and what had helped us. And unfortunately, there were a lot more things that hurt us than helped us in 18. It's literally the entire reversal so far in 19. The things that are on the left side as winners were the exact things that were on the right side as losers in December. The ones that were winners or losers in January. Now, the good news in January is everything literally went up, so even our losers were up, just not up very much. And so in the U.S., it was financials, which we felt were severely undervalued. Both B of A and Citibank had strong quarters. They reported for the fourth quarter. I'd highlight they reported strong quarters throughout the year last year, and it just didn't matter. People continue to sell that sector down. We'll spend a bit more time looking at some of the fundamentals of the banks and why we think there's still great value here. And then, of course, Alibaba also had a strong bounce, and we continue to hold that stock. The loser was Intercontinental Exchange, which has done okay. It outperformed last year. It does have some exposure to the UK financial markets, so there is some concern about Brexit there. So that's a position we're monitoring and doing some work on in terms of where we go with it in the future. On the Canadian side, Canada, of course, has been a horrible environment for the last 5 years anyway. Underperformed for the last 10, but dramatically for the last 5. Our winners were, again, energy and financials. So these are names that really outperformed. So Precision Drilling and Parex both up over 20%, Suncor up 11%, and then both CIBC and Manulife bouncing back by about 10%. And on the loser side, CGI, which was one of our better stocks last year, up only 4% so far this year. And Grand Tierra, a remarkably cheap energy producer in Colombia, which we also bounced a little bit, but we think has a lot further to go. So to follow my comments for financials, Citi and Bank of America, why we still like them. You can see their ROEs are above the peer group average. For Bank of America, substantially so. Both banks trade at a meaningful discount to their peers, Citibank being the cheaper one, trading at over 20% discount, while Bank of America has done a bit better and is trading at just over a 10% discount. But what we like the stories, besides the fact that they are banking into a healthy U.S. economy, is they've both been focused on improving their operational efficiency. And you can see the efficiency improvement over the last 2 years has been higher than the peer group for both of them, and in particular for Bank of America, which has just done a tremendous job managing expenses. So both stocks remain cheap, deliver attractive ROEs, and we think are well positioned to get back to a fair value this year. Not only are they substantially cheaper than the market, they're substantially cheaper than the financials have normally traded at in any normal environment, and they are the cheapest within the financial group. So we continue to see them as attractive. Manulife had a difficult year last year. At one point in December, it hit a PE that was lower than what it hit in the great financial crisis. Yet it grew earnings almost 30% last year. We're going to get the fourth quarter numbers relatively soon. ROE was up a lot. There was this pending lawsuit about old insurance contracts that a hedge fund had bought up and was trying to force them to honor in the billions of dollars by launching a money market fund. That has started to fade as people realize that is probably not going to go forward. And at 10 times earnings, we see up to 40% upside in Manulife, and it continues to be a position in our book. On the next slide, you can see Manulife trading well below the industry relative to where its ROE is on a price-to-book basis, and we think that offers substantial upside. Again, when it hit its trough, you were getting the North American business for free. It has bounced back roughly 9 or 10% from there, but still a lot of value that we think to be unlocked in the stock in 2019. In terms of energy, obviously been a difficult place to invest the last 5 years, really, since the peak was hit in 2014. We would say at this point that the value is exceptional, and that's largely because the entire sector has been abandoned by investors. When that happens, there has been little to no discrimination made between high and low quality companies, so we see opportunity to find exceptional value on high quality companies. We do think the fundamentals for crude are certainly solid at current levels, and they are improving. OPEC cuts are in place and are being adhered to. The U.S. production growth, which is now the U.S. is the largest oil producer in the world, that growth is set to slow in 19 and 20. And in fact, with all the worries over recession, the evidence is that demand growth has not slowed. So You have a more constrained supply coming into the market while demand continues to move ahead of pace. And the result is oil prices that, for all everyone's bearishness 2 months ago, are sitting now in the mid-50s for WTI and well over 60 for Brent. Importantly, given the pain in the sector from the share price front, companies have pretty much entirely shifted to focusing on buying back their cheap equity as opposed to investing in new production. And that again helps constrain supply growth. We do see the potential for 30 to 40% upside in names, and we're very conservative on our view of that. We don't need crude to go to $80 or anything crazy. It can just drift modestly higher, effectively to where it almost is right now from when I did this slide. Mid to high 50s in WTI, and same with Brent, mid to high 60s. And you get a lot of upside in these names. And even with that, valuations would still be at a substantial discount to both historical norms and the market. The best way to play energy, our best idea, is Parex. It does give us exposure to Brent versus WTI. It has its production cost in Colombian pesos, which is a discount to the US dollar. It has incredibly strong balance sheet and cash flows, we'll see in a second. Strong internally funded growth, and they're in the middle of a substantial buyback of their stock. So you can see that they are focused entirely on Colombia. They sell their oil at a small discount to Brent. They have been growing production actually over 20%, 25% last year, and we think they'll be over 20% again this year. Reserves have been growing even faster. We will get a reserve release from them next week. It may not be 40%, but we do expect it still to be very, very solid. They have their capex that drives that 20% growth is entirely funded from their own cash flow. And on top of that, they generate another $300 million of free cash flow at $60 Brent, which is, we're well above that already. They have no debt and $200 million of cash on the balance sheet, and as a result, they have a substantial buyback plan in place at over 10% of the stock outstanding. So we think that's a very low risk, very cheap, high reward way to play what's happening in crude oil. Just quickly on the hedging front, given my comments that the risk reward is more balanced, in the last week or so we have started adding put spread collars on some of our names. We, as you know, as I mentioned earlier, we've had big moves in the financials, and so we've hedged our positions in Bank of America and Citibank. Also had a nice move in United Health, and we've started to hedge that in. And as I mentioned earlier, we already had hedges on our tech exposure in the triple Qs and the IGV. So this is of course beyond what we do with index puts to protect the overall book. These are more on individual names where we've had big moves and feel like we want to protect the gains that we've already got. From a portfolio standpoint and hedging, since the great financial crisis in 2009, that sell-off we had in the fourth quarter was the most severe that we've had. But what was bizarre about it is that volatility through that sell-off remained well below what you would normally expect. And then it repriced much higher once the drop-off happened around Christmas. So the VIX remained well below 25 while the sell-off gained momentum, and then as we went into that, what people are calling the Christmas Eve massacre on the day before Christmas, the VIX popped over 35. And you actually saw that in the performance of our fund. We were having a hard time matching the drops in our equities with our hedge book earlier in December, but by mid to late December, we were offsetting those declines very well with our hedge book, and that was just a function of the VIX finally pricing in what was happening. In terms of where we are right now, we were fortunate we did move to a very short duration, meaning our expiries on our puts are very short term. Usually we've been running 1 to 2 weeks. Normally we'd be running 1, 2, or even 3 months. And the reason for that is, we thought the market was oversold. We thought the chance for a sharp bounce back were very high. And if that's what you think, you want to keep your duration very short so that you can keep resetting at higher strike prices as the market moves higher. And we've been able to do that. One, it keeps our curve close underneath us as the market moves up and as our fund moves up. But second, it also means we have less invested at any point in time in protection, and so the amount we're burning as the market goes higher is much more limited. So that both of those have been helpful for us, which has helped us have a very good January. And now at current levels, similar to what we're doing on the put spread collars, we are starting to extend duration and look a little farther out. We feel like 27 to 2800 is certainly much more difficult level for the S&P to get through without some of these broader macro themes that are causing uncertainty disappearing. And so we are hedging longer term and trying to build a solid underpinning for our book here at these levels. So with that, that is, I'm going to conclude. Just a couple of thoughts. January was excellent. We're very thankful for that. We still think there's a ton of value in our book that has yet to be unlocked, and we're not thinking that that's all we're going to get this year. Our intention is, of course, to build on the strength we've delivered in the book in January as we move through certainly this quarter and next. And we think the book's well positioned to do that. That all said, to my comments on hedging, we are going to maintain a fairly strong hedging program here, given how sharp the rally has been. So our view is that the overall market may be more range bound here, but certainly areas such as financials and energy have some room to move higher. And with that, I will say goodbye and look forward to speaking to everyone again at our next webcast.